I'm Owen Bigland. This is the Inside Edge video blog. By popular demand, I'm going to do another blog here on investing both in real estate and in stocks, and why you should own both, and the pros and cons to owning both. Now, a lot of this I cover in great detail in my book, but I get a lot of people that have questions on what they've read in my book, and so I'll want to clarify a few more things. And what comes first, which is a big question a lot of young people will ask me: what should I be doing first, buying stocks or buying a home or my principal residence? So let's address them here. First, let's talk about real estate. Real estate, I've always, and I talk about it in my book, I always think that should be your first step, or at least you can always start by putting a little bit of money in your TFSA or putting a little bit of money into your RRSP once you're working. But keep in mind, there's always time to really double up on that or put more into that RRSP, because any unused room can get carried forward in later years. Same thing with the TFSA. So my recommendation would be to, if you're, for every $100 you're saving, I think at least half of that should be going into saving for the down payment of a house early, a condo, townhouse, whatever. Maybe even 70 cents of every dollar, for a number of reasons. And I talk a lot about this in my book, but the big advantage to owning your principal residence is that tax-free growth. The principal residence exemption has created more millionaires in this country than all other sources combined. That's a fact. And you want to take advantage of that. All the capital gains, as long as it's your principal residence, flow to you tax-free when you cash it out. And that is a huge advantage. It's the best and only tax shelter we get in Canada. So you should take advantage of it. And that's why it's so important to buy that house, that principal residence, sooner rather than later. The sooner you buy it, the more capital gains and the more wealth you're going to create, sheltered, tax-free. It's, as I say, it's minted more millionaires in this country. I mean, it's not uncommon for me to have clients, that bought homes in Richmond 20 or 25 years ago for $250,000 or $300,000 and are selling them today at $2.5 million, $3 million. They've got a $2.5 million capital gain there that goes to them completely tax-free. $2.5 million. I mean, you would have to, outside of that, you would have to create an RRSP or a retirement fund of about $4.5 million, which is going to be taxable as you draw it out, to create the same income that selling of that principal residence would be with a $2.5 million gain. Good luck trying to get $4 or $5 million into an RRSP. It's not going to happen. So the principal residence should be the first step. And when you're first starting out, saving your money, getting your first job, I would say 50 to 70 cents of every dollar you're saving, I would earmark for the down payment. The other 20 or 30%, sure, put into your RRSP, start that going, but you can always make up the unused portions of your RRSP later on, especially when you get into your higher income earning years, where you'll need that tax deduction much more than in your early years. Now, the cons to buying real estate, of course, is it's expensive. You've got to save for that down payment. You're going to need 10, 15, 20% down. The market's pricey here in Vancouver, so depending on what you're buying, you're going to need $30, $40, $50, $60, $100,000 to get into the market, which isn't easy. The other thing with real estate is it's expensive to get in and out of. It's not liquid. It takes time to sell a property. It takes time to buy a property too, but to sell it or liquidate a portfolio of real estate takes time. It's also expensive. I'm not cheap. I'm going to charge you 7% and 2.5% on the balance to sell your house. I'm going to offer a full cooperating commission to a realtor to bring us a buyer. So on a typical $1 million home, you're looking at $30,000, $32,000 to sell $1 million home. Not cheap, and it takes time. On the other hand, stocks. Now, stocks have got, and one last thing with real estate, the other pro with it is it's not quite as volatile, or not nearly as volatile as the stock market. It's almost like a forced savings account. You buy the home, it's tangible, which is nice, easy to understand. You're buying a house, you're buying dirt, you're buying a structure. You need a roof over your head anyways, so it has a tangible use. You live in it, enjoy it, and let the capital gains do their thing. You don't have to keep an eye on it every day. Too many people, especially in Vancouver, real estate's a blood sport here. I think they pay way too much attention to the market. When I was buying real estate, investing in real estate, or when I bought my first home 30 years ago, I paid very little attention to what the market was doing. But then again, we didn't have the internet back then or anything else. Now it's 24 hours, 7 days a week, non-stop coverage of the real estate market. I think that hinders a lot of people. Too much activity going on, too much to keep an eye on. I'm telling you, buy your principal residence or even buy an investment property and don't pay too much attention to the market. I wouldn't. I'm a realtor, I have to, but before I became a realtor and I was a real estate investor, I didn't pay much attention to it. So much less volatility in real estate, and you let time do its thing. Stocks, the big advantage to buying stocks or equities is it's a much smaller barrier to entry. You can start buying ETFs for $100 a month if you wanted. You can buy 10 shares of Pepsi for $1,000 right now. So a much less capital requirement to get in. The other thing, if you buy the right type of stocks, which I talk about in detail in my book, I only buy companies for the most part that pay me a dividend. That's a sign that the company is healthy, it's earning profits, lots of free cash flow, and it'll pay you out a quarterly dividend. You then take those quarterly dividends and reinvest it into more stock, either in that company or a company that you think is at a better value at the time. So the nice thing is it's passive. It allows you to produce a quarterly income in the form of dividends that you can reinvest. The transaction costs on stocks are also much less than real estate. Depending on your wherewithal and your financial, what type of account you have, in general, you can trade stocks, buy or sell for around $9.99 through TD Waterhouse or through Royal Bank. So very easy and very liquid to get in and out of the stocks. Downside to the stocks, though, is the volatility. And it's something that people pay a lot more attention to because of the volatility. Stock market's open 5 days a week. Prices are up and down. But I talk about it in my book, how the movements you see in a stock like Apple or TD Bank or Procter & Gamble or Johnson & Johnson, oftentimes the price increases you're seeing on a day-to-day basis have very little to do with the company itself. These are just market swings, trading that's going on with large institutional investors. I talk more about it in my book, and if you haven't bought it, you should. But I'll talk about how you can tune out the noise. Buy quality companies that pay a dividend, collect those dividend streams, reinvest them, and just stay the course. Or what Warren Buffett says, continue to build the snowball up. But the disadvantage with stocks, though, is it's a lot more volatile and there's a lot more price swings. My advice, though, just like with real estate, buy the stock, monitor it by all means, read the quarterly reports when they come out. You don't have to, it doesn't take more than half an hour for me each 3 months, each quarter. But don't pay a lot of attention to the day-to-day swings in the market. They're irrelevant. They're not going to matter. Buy the stock, hold it, look at it every couple of years and see where it's at then. So those are the big differences between real estate and stocks. Both have their pros, both have their cons. Everyone should own both. That's what my book is all about, Along for the Ride. It's about buying appreciating assets that will also spin off cash flow. So if you're buying real estate outside of your principal residence, if you're buying an investment property, your tenant is paying down that mortgage for you. You might even have some positive cash flow on it. If you're buying good quality dividend stocks, you're not only going to get the capital gain over the long term, but you're going to collect a quarterly dividend check, just like a rent check. I actually look at my stock portfolio like I would an apartment building. And I talk about that in my book, how I've got a 30-unit apartment building. On the first floor, I've got Coca-Cola, Johnson & Johnson, Merck, Pfizer, Apple. On the second floor, I've got McCormick, you name it, Pepsi, TD Bank, Royal Bank. All my tenants are well-established upstanding citizens that pay me a quarterly rent check every month, every 3 months, uninterrupted. And not only am I going to participate in the capital gain of the apartment building going up in value every year, or not in lockstep, but over time, I'm also collecting those nice cash flows in the form of dividends. So you really want to have both, but both have their pros, both have their cons. I'm Owen Bigland. As always, hope you learned something. Thanks for watching. If you haven't subscribed to my YouTube channel, please do. I'll see you next week.